The broadcast is now starting. All attendees are in listen-only mode.
Good evening and welcome to another edition of Ironwood's quarterly Market Insights webinar. We sincerely thank you for joining us tonight. My name is Rex Weeks. I serve as portfolio manager at Ironwood and am a holder of the Chartered Financial Analyst designation. I'm excited to also present Craig Moore, Senior Wealth Advisor and Director of Marketing at Ironwood, and Tim Carter, our Tax Director. We do welcome questions, but ask that you please type them into the GoToMeeting message box and we'll field them at the end. Hi, everyone. Thanks for joining us this evening, taking time out of your busy schedules. On the invite for this webinar, we clued you guys in that it would be a little different this time around than what you guys are probably used to. I will still be taking about 10-15 minutes to go over the markets and just how it applies to your guys' portfolios and Ironwood as a whole. And then I'll pass it off to Craig, who will speak about the One Big Beautiful Bill. We talked about it last time, but he'll give more detail, dive a little deeper into it, and then talk about year-end tax strategies and how that bill is going to affect our clients. And then finally, Tim will go over some specific case studies to kind of get into the weeds and show you guys exactly how that impact's going to be felt. Next slide. Yep. Disclosure, and then a quick webinar agenda, kind of everything that I just mentioned. Market insights, One Big Beautiful Bill, tax strategies based on that, and then some examples that we'll go over. And then, like I said at the beginning, if you have any questions, just get them into the questions box and we'll field them all at the end. Before I get into the market insights, couple housekeeping items. We are holding a volunteer event. We do it at for Feed My Starving Children, just a way to give back to the community and a nice way to meet clients if you haven't met any of our staff or only know a few faces here. It will be on December 5th from 2:30 to 4 p.m. Ironwood will be hosting a happy hour immediately after at Bonfire Craft Kitchen. The registration email has been sent out and registration closes on November 28th. If you have any questions, feel free to reach out to me or your advisor. And then what we had mentioned, our annual client appreciation event was a huge success. Not only did we have 144 players come out and enjoy a free round of golf, we had 160 total clients and some business partner sponsors at our lunch right after, where we raffled over 25 items and gave away a grand prize. It was actually my favorite item. It was a golf bag and hat that was designed by one of the patients at Phoenix Children's Hospital. So that was very cool. And then speaking of them, we were able to raise and donate over $5,000 to help out the expenses for all the kids in the care that they provide for kids over there. So that was really cool. So appreciate any of you that came out and hope to see all of you there next year. So getting into the economic data, it's been kind of a cloudy last 3 months. As most of you know, the government shutdown has been in full effect. This chart on the right is a little outdated. It's actually now the longest government shutdown that we've ever seen. So a lot of the data that we rely on hasn't been coming out since the end of August. But luckily we have some other ways of kind of getting a temperature gauge on how the economy is running. So the 10-year at the close of the market today was sitting at 4.01%. Last webinar was at 4.22, so it's come down almost a quarter of a point, 21 basis points. And this is mainly due to the weakening of the labor market, which I'll get into a little more later. ISM manufacturing continues to sit in contraction territory over the last 3 months, but the service side has remained at or above 50% threshold. And of course, like I've mentioned, the service side is more applicable to our economy. So that's the more, people say more important one. And then the economy has added an average of 32,000 jobs per month over the last quarter. This number is kind of reinforcing the idea of slower growth in the labor market that we started to see last time we spoke. Next slide, please. And then, like I said, we don't have Q3 GDP because of the shutdown. So this is updated through end of Q2. The Atlanta Now estimate is anywhere between 2.7 and 4% GDP growth for Q3. So, split the difference, that gets us to 3.3%, which would be a solid growth rate for a quarter and for this economy. And that would mean that we'd have two consecutive quarters of above 3% GDP growth. And while the services look strong, you could say that the Liberation Day shock of Q1 was kind of an outlier and that we've been humming along. But I'll kind of get into it later that below the surface, there are some cracks that are kind of starting to widen. Next slide, please. So like I said, on the surface, GDP numbers look pretty strong, above 3%. But if you take out the effects of data centers and kind of this AI build out that we've seen, you can see this graph on the right, just how crazy the spend is getting just for these 5 companies, Amazon, Meta, Google, Microsoft, and Oracle. If you take out the dollars that are going to data centers, GDP growth in the first half of 2025 was 0.1%. So obviously, if AI and all these data centers, if all of this is going to pan out, doesn't really matter in the end because growth is growth and it's going to help the economy. But relying, as we've said, all this concentration in one area of the market, if AI doesn't pan out to be everything it's built up to be, then we could be in some trouble. If these AI chips start to fall out of favor. Next slide. Now we're going to touch on inflation, the labor market, and kind of how the Fed's reacting to both sides of their mandate. So inflation breakdown, the September reading came in at 3%. As we've talked about in the past, the Fed has kind of targeted that 2% number as what they want to get down to. While we're still sitting above that 2% because of the weakness that we've seen in the labor market, the Fed has shifted its attention. So that 2% target rate isn't really applicable because they're more worried about the weakening in the labor market, which I'll touch on this next slide. So labor demand. The labor market, as I've continued to echo, is showing signs of weakness. While a negative payroll number usually signals a recession, the lower average that we've seen over, since the middle of the year is really, it's flashing. It's not red, but it's flashing orange, and has caused the Fed to direct more attention towards the labor side, the full employment part of their dual mandate. Initial jobless claims would give us a more real-time understanding of the health of the labor market. But like I mentioned, because due to the government shutdown, we haven't been getting that real-time update. So it's been pretty cloudy for not only the Fed, but us as investors to kind of understand how the economy is doing while the government's been shut down. Next slide, please. And then going off that, the labor market, you've seen a lot of these headlines saying, massive layoffs due to AI, machines are taking our jobs, all these different things. There was a report by Challenger, Gray, and Christmas that came out saying U.S.-based employers cut more than 150,000 jobs in October, which would be the largest reduction in more than 20 years, since 2003. Not only is the number of layoffs increasing, but the number of companies that are having layoffs is increasing as well. It was 400 in September, and that jumped up to 450 in October. According to the same report, cost cutting was the top reason for layoffs in October, followed by AI, and then followed again by the impact from Doge. So far this year, cuts are at the highest level since 2020. It's as of the end of October, we've seen 1,099,500 job cuts. So again, all these numbers and these mass layoffs, you can see these charts showing by month and kind of these tech companies, just how many people they're laying off, and that's attributed again to cost cutting, mainly cost cutting and efficiency that AI is bringing to the marketplace. Then the latest Fed decision, I kind of alluded to this earlier. On October 29th, the Fed decided to cut its policy rate by 25 basis points to between the range of 3.75 to 4%. There were two dissenting votes, which means two Fed officials or governors that didn't agree with this consensus. One wanted to cut by 50 basis points, and another wanted to leave the policy rate unchanged. This is pretty rare. We've seen a couple dissents in the recent meetings, but two dissents is pretty rare. And, I believe that mainly points to just the kind of murky waters we're navigating in right now, and just how kind of stuck in the middle the Fed is of their price stability and full employment mandate. So, worrying about inflation, trying to keep inflation down, worrying about price stability, and then also they don't want the labor market to fall from grace and see a bunch of layoffs like we had like in 2008. Another key point from this meeting was the end of quantitative tightening. This is mainly to hopefully enhance liquidity in the market and put downward pressure on rates. So they're kind of being restrictive since the end of COVID. We had they were raising interest rates, and now of course they've started to cut interest rates, and then this is another mechanism that they have in their playbook to put downward pressure on rates as well. They also mentioned that they will stop reducing their balance sheet. This is mainly due to signs of stress in money markets and concerns, again, regarding liquidity in the financial system, and then just overall economic conditions in regards to the labor market. So they're doing this as kind of as a precaution. They're not moving to the other side and starting quantitative easing, but they're just kind of pausing, see how the market reacts, and then if they need to, they can continue tightening or they can begin to ease. And then based off of Powell's, he always does a speech after the decision. Based on that speech, the December cut came into question, which markets were kind of already pricing in. So then this next slide, again, a slide you've seen before, it just shows the relationship between the 3-month Treasury rate and the 10-year. The Fed obviously has more control over the 3-month, the light pinkish line, and then the 10-year has different things baked into it, like term liquidity premium and inflation expectations. So that one is a little bit, or is more controlled by the market. And you can see that the first drastic drop came in September when the Fed announced its 50 basis point cut. And since then, the 10 years kind of stayed in this range. But recently, as of September, when we started seeing this weakness in the labor market, the 10 years started to finally come down because it realized that the market is those cracks in the market are starting to widen. And then the next slide, it just shows the probability of a cut in December. So this kind of after Powell talked, it kind of dropped to, I think it was about 60%. And then after these pieces of data keep coming out, and we had a couple CEOs come out and say that valuations are extremely high, and that kind of spooked the market. And since then, over the last week, the probability is raised back up to 70%. So it does, as of today, look as though we may get another 25 basis point cut in December. And then next slide, just kind of tying this into earnings. what Powell and a lot of people have talked about is we're kind of seeing a K-shaped economy. Basically, what this means is one side of the economy is going up while the other is going down. You have your top earners, highest earners, biggest corps who are making the most money and account for half of spending in the U.S. They're not having any problems. And then you have the bottom 10% of people. These are, the low-income households, mom and pop companies. They're not experiencing the same economy. They're struggling with inflation. They're not seeing these large profit margins. They're having to shut down their stores. And this is really becoming the overall theme of the economy. And you can see it in the stock market. You see these tech stocks that are seeing these large gains, and then you're seeing these smaller companies, and even the rest of the S&P 500, who are missing their earnings mark and revising down expectations going into the future. So this is something that we want to keep in mind and kind of keep an eye on moving forward. And then the next slide, same kind of thing. Won't get into this too much, but it's just showing again, the Magnificent Seven is really bolstering and holding up the rest of the S&P 500, something that we've talked about probably ad nauseum at this point. And then the next slide, same kind of tune, but just shows, which is crazy to me. This is basically showing that NVIDIA is now so big that it would be the second largest economy in the world, behind the United States. It's like, I think last time, again, it's about 8% of the S&P 500 just by itself, and almost 14% of the NASDAQ. So concentration risk is at an all-time high and seems to just keep rising. The next slide, just wanted to point out, this is just top 10 companies by decade of the S&P 500. Only 3 of the top 10 companies from 10 years ago are still in the top 10 now. So this high concentration that we see, this is one of the risks, right? Like, these companies drive the returns that you see in this index. And because we're long-term investors, we're worried about where we're going to be at in 10 years. 70% of these companies aren't even in the top 10 anymore. Not to say that they're not around, but they've kind of come back down to earth from a valuation standpoint or a size standpoint. So again, just highlighting some of the risks that can get baked into these indices, even when you think you might be well diversified across 500 companies. Next slide, just another way to show just how crazy the spending is getting in the investment in CapEx of these companies for the AI build out, whether it be computer equipment, communication equipment, semiconductors, data centers. Especially here, if you live in Arizona, you see a new data center popping up in a random dirt lot. Seems like every other month. And then this final slide is kind of, what's the risk, right? Like, so we've experienced the positive of this AI story working out so far. The last 2 years, 3 years, the stock market has gone on this phenomenal run. Anyone who's invested has made money. So Rex, what's the problem? What could go wrong? The issue, or what hasn't been an issue, is that these companies have had such big margins and such large stockpiles of cash and free cash flow that they've been able to fund it without taking on debt. So even if these things didn't necessarily pan out, okay, we've sunk costs kind of thing. Now we're seeing, specifically, as you see here, companies list out debt, Meta, Oracle. They're issuing debt to try to raise more money to fund these projects. And like I said, the spending's only going to get crazier and crazier. So unless they can keep up from a free cash flow perspective, they're going to have to raise more and more debt. And if they keep bringing in revenue and paying off that debt, that's fine. But if we get to a point where these chips become useless, there's a newer, better chip, or China is able to recreate everything you need 100 NVIDIA chips to do with one chip, then these companies can soon, worst case, go into default and see their stock prices tumble. So this is something we really want to keep an eye on moving forward. It's kind of the first indicator that, not all bubbles are bad. There's bubble when railroads first got invented, bubble when the internet was invented, both amazing things that changed the course of human history. I'm sure AI might do the same thing, but there are just still things they both saw, those bubbles burst. So we just want to make sure we're diversified across markets, across stocks, bonds, alternatives, to keep your guys' money as protected and as safe as we can from these large downturns that eventually do happen. And with that, I will pass it to Craig.
Hey, thank you, Rex. Appreciate you letting myself and Tim Carter here in a few moments hijack some of your quarterly webinar. Today, I'd like to spend some time discussing the One Big Beautiful Bill. And I do not mean the handsome gentleman on my screen with some nice biceps. What I'm referring to is the new piece of tax legislation that was passed back on Independence Day, July 4th. And from there, we'll go on to discuss some end-of-year tax planning strategies, including 2 popular charitable giving strategies, and look at some various case studies along the way. So with that, let's jump in here. So as I mentioned, the One Big Beautiful Bill, kind of think of it as maybe Trump tax reform 2.0. In Trump's first administration, we had Tax Cuts and Jobs Act, and now we have the One Big Beautiful Bill. The reality is that this is a fairly expansive piece of legislation, and by no means is the few points that I'm going to share with you today meant to be exhaustive of everything in the legislation. But I'd like to think of this as the things we're showing are applicable to most Americans, and certainly. If there's other things out there, you can work with your advisor to see how those impact you. So if you're a client of Ironwood on the call for years, you've heard us talk about tax rates and how after 2025, we don't know what tax rates look like. Well, now we do, by the way of this legislation. Tax rates have been written in permanently with the One Big Beautiful Bill. I do caution to say that be careful on how you interpret permanency, because what that really means is that it would take some future piece of legislation to change the tax rate. So as of now, pre-OBBB, if you see here on the chart, you have the 12, the 22, and so on. That would have expired at the end of 25, and now those have been made permanent. Additionally, there's been a bump in the standard deductions. So if you're a single filer, you got a $750 bump. For a joint filer, you got a $1,500 bump. One section down here is probably certainly one of the most hot button topics with this piece of legislation. It was certainly bantered about on the campaign trail on our recent presidential election. And this is kind of the answer to that promise of no taxes on Social Security. And so, again, we want to be careful how we view that. But previously, a over 65 years of age single filer, would have received a $2,000 additional standard deduction. And for married filing joint, you would have received $1,600 per qualifying spouse, again, over the age of 65. Those are still there. But now, income dependent, if you see over here on the far right, you can get up to an additional $6,000. So for example, if you take a single filer, they could get $15,750, get another $2,000 from the original senior deduction. And then if their MAGI, modified adjusted gross income, falls between $75,000 and $150,000, my apologies, it looks like there's a little typo there, then they would be in phase out range and over, 175 is correct. They would be in phase out range, and over $175,000, they would be fully phased out of that $6,000 deduction. So again, it's an additional deduction, but that does come with a caveat in MAGI phase out. Next, we have the state and local tax deductions, or better known as SALT. Previously under TCJA, that had a $10,000 cap on it. And so a lot of folks don't realize when you're looking at those itemized calculations, between property taxes, maybe state income tax. Hypothetically, let's say you had $18,000, that would have been capped at $10,000. Well, now beginning in 2025, that cap has been raised to $40,000. It increases by 1% through the year 2029, and then it reverts back to $10,000 in 2030. Also with income caveats associated. There are tax deductions for tips, tax deductions for overtime pay. Just note there that what you're seeing here from a thematic perspective is that there's caveats. There's a ton of income caveats to a lot of these different things. Child tax credits have went up by $200. The phase-out ranges remained the same. Estate and gift tax exemptions that were bumped up back with TCJA were set to expire and revert back to their previous amounts pre-Tax Cuts and Jobs Act. Those have now been made permanent with annual inflation adjustments. The next piece, this auto loan interest deduction, that is something new. This is a new puzzle piece, if you will. So think of it kind of as a carrot out there to promote domestic buying, if you will. At least that's how I interpret it. So you can now deduct up to $10,000 of annual interest on new loans from 2025 to 2028 for vehicles assembled in the United States. What makes it so interesting is that it's an above the line deduction. And so for those of you who don't know, think of AGI, adjusted gross income. Anything that's above the line would drive AGI down. And that may be a good thing depending on your individual tax situation. But again, we see an income phase out. Charitable donations for non-itemizers. I love to do charitable planning with my clients and talk about that. So this is actually one of my favorite pieces of the legislation. You'd be surprised at how many times folks say, well, I donated to said charity and it's great because I get a tax deduction. What a ton of folks don't realize is that that's only true if you're an itemized filer. So if you're a standard deduction filer and you have philanthropic endeavors and you give away money and collectively your itemized deductions don't surpass the standard, then fantastic, congratulations. You've had a great heart and you've helped some noble cause, but you did not benefit from it from a tax perspective. This allows you to do so. And I acknowledge that the numbers aren't very big. Hopefully this is just a starting point. But starting next year, why it doesn't start this year, I don't know. But starting next year, a filer, $1,000 single, $2,000 joint, can make a cash donation, even though you're a standard filer, and still benefit from that. EV credits, I'm sure everyone knows at this point, those are gone. Those expired at the end of September. And then other energy efficient credits go away at the end of the year. So it may be worth, with a couple months remaining, looking into those. So now let's kind of take that thought that we're better armed and we have some more tax legislation knowledge, and let's move into talking about some year-end tax strategy with a couple months remaining here in the year. So I think in order to truly take advantage with year-end tax strategy, you have to know what your personal tax environment looks like. And you have to be in tune with what your income will look like for the year. So I'm sure a lot of you know that at Ironwood, we accomplish this by taking a year-round approach to tax planning. And by running projections, it allows us to be much more accurate with numbers and strategy, and not really leave your tax planning up to guesswork. So I'm not going to spend really that much time on the basics as you see here, or table stakes as they're listed, other than just to mention them. But want to certainly work through this list and talk about different things. And so now that we've entered in November, we have a couple more months, couple more payrolls if you're still working, to make sure that you're either maxing out retirement plans or funding to the extent that is tax efficient prior to year end. We have until the tax deadline in April 2026 to fund HSAs or fund IRAs or Roth IRAs. 529s, which gives you a state benefit, needs to be funded by 12/31 as well. Bunching deductions. So if it's an income spike year, perhaps bunching deductions is a route to go to try to bring down your total taxable income. And you can do that potentially with medical expenses, maybe property taxes. I'm going to show you an example of charitable bunching here in a moment. And then we're going to talk about harvesting gains and losses, have some examples with that. And then we kind of already talked about tax credits a little bit. So energy credits, and then with education, doing things to manage MAGI to maybe be in line for some various educational credits. And then we're not going to talk a whole lot about businesses or small companies today. It's a little bit outside of the scope. Again, if that's you and you're on the call, I would encourage you to speak with your planner. But again, we have a couple months. So thinking about things like managing income and expenses, maybe it's the startup of an employer plan, and those types of things, and figuring out, what your qualified business income deduction looks like and how that partners with your personal tax return. So I want to ask you, why didn't Sherlock Holmes pay a lot of taxes? Well, it's because he had brilliant deductions. A little humor for you there. Break up some of the slides. So one of my favorite topics, charitable planning. And as we enter to the holiday season, I think it becomes maybe a little bit more on the top of mind for everybody. So I wanted to talk about a couple advantages and benefits of charitable giving. Emotional well-being. So a helper's high, as sometimes they refer to it. Community involvement. So being active in a charitable cause can lead to a deeper connection within your community and maybe create a social network for you and give you a sense of belonging. Example setting. As you do, you can inspire others. Or if you're a parent, instilling that character trait within your children or other family and friends. And then for today's purposes, tax relief. Oops. So first we're going to talk about qualified charitable distributions, or as they're known, QCDs. Very simply, what a QCD is the transfer of money from your IRA in the form of a gift directly to a charity. And I do want to note that there are some more complex strategies. We're not going to talk about them today, but a lot of them involve certain types of trust and estate planning. We're not touching on them because given where we are in the year, that it would be really hard to get those types of things set up. Again, would encourage you to talk with your advisor if that's of interest. And if you're a guest of Ironwood joining the call, certainly we'd be happy to speak with you on that as well. But qualified charitable distributions is a unique tax strategy. It's available to you once you turn 70 and a half. They go towards satisfying any RMD requirement, and depending on age, that can be age 73 and up, depending on a couple of different things. The amounts that you can donate on an annual basis are typically inflation adjusted annually. This year, a single filer can donate up to $108,000. Married filing joint, $216,000. Some of the benefits include lowering AGI, which can actually potentially increase other floor-based itemized deductions. So, for example, right now you can only itemize medical expenses above 7.5% of AGI. Well, if AGI is lower, then you can get to that 7.5% much quicker. It can help you avoid potentially higher Medicare surcharges down the road, known as IRMA tiers or IRMA surcharges. It can create more room for non-qualified dollars to be captured at preferred capital gain rates. And it can reduce future RMD amounts that may create tax inefficiency. So let's look at a case study. We have Bob here. Bob's a single filer. He's 75 years old. We're talking about 2024 here, and he needs to take an RMD from his traditional IRA that's valued at a little over $1 million. That results in an RMD of over $42,000, and his ordinary income in 2024 is $80,000. So Bob has a couple different options here. Option one, Bob's AGI is projected to be $80,000, but if he takes his RMD income, it will increase his AGI to over $122,000. Then Bob would donate his RMD income to charity, and he would take an itemized deduction equivalent to his RMD amount. And we're going to assume that Bob has no other itemized deductions. Option number two is Bob transacts through the QCD vehicle to an eligible charity. Again, that's taking the money directly from the IRA to the charity. Bob then just takes a standard deduction. Remember, he's a single filer of $14,600 plus an additional standard deduction of $1,950. Remember, this was 2024 numbers because he's over 65. All right, so let's see what that looks like numerically for Bob. So option one, again, AGI is 122 because he put the RMD in his pocket. He then turned around and gifted it to a qualified charity, and he received an equivalent itemized deduction, creating $80,000 in taxable income. Option two, Bob does not take receipt of the RMD, although it's satisfied. Option two, he executes the QCD and sends the money from the IRA to the charity. He then takes his standard deduction, inclusive of the over 65 senior deduction, and creates federal taxable income of $63,450, which is $16,550 lower by executing the QCD strategy. So in both scenarios, Bob was in the top end 22% marginal bracket, but in option two, taxable income was $16,000 and change less. Other implications are that in option one, Bob would have put himself in the first IRMA tier, which means he's paying an additional surcharge for Medicare. So option two is saving Bob $3,600 in federal taxes and additional almost $1,000 over the course of a year in IRMA expenses. So in this example, the QCD saved Bob over $4,600. I can personally say that I have a couple clients that are utilizing this strategy, and it took some getting used to, but once they fell into the habit and understanding the logistics and how it worked, they're thrilled at this strategy, and they execute it annually every year, and they get a ton of joy in being able to send that money directly to charities. Next, let's talk about donor-advised funds. And again, fairly hot button topic in financial planning. And I think the way you think about donor-advised funds is kind of think of it as an account that serves as a conduit to various charities while allowing you an upfront tax deduction. And you can then disperse the funds as you wish at any point in time to at your discretion. And so you can donate cash, you can donate appreciated non-qualified securities, you can donate some various other types of investments as well. And once they go into the donor-advised fund, you can receive a tax deduction, and then the funds can be invested for tax-free growth. And the fund itself acts as a charity, and then you retain control to distribute the funds as you deem fit. So again, donor advised funds, DAFs, are housed within a 501c3 entity, which is a charitable arm of any qualified custodian. So here at Ironwood, you utilize Fidelity or Charles Schwab. Both of them have these capabilities. If you put cash into the donor advised fund, you can take a deduction limited up to 60% of AGI. Appreciated stock that's held 1 year can be limited or deducted up to 30% of AGI. And you may ask yourself, well, why is that between cash and appreciated stock? That's because by donating the stock, you avoid the capital gain implications of selling said stock. It allows for bunching, and we'll look at an example of that here in a moment. And then, as I mentioned, you can direct the funds at your discretion at any time in the future to 501c3 organizations. Again, funds can be invested inside of the DAF and grow tax-free, so your contribution to charities can grow over time. And note that donor advised funds cannot be funded with QCDs, since we just looked at those. So look at a case study here. Bob, our good friend Bob, he's went and got himself married. And now all of a sudden, Bob finds himself in the 35% tax bracket. So Bob married really well. They're both age 65 and are entitled to a standard deduction on their federal tax return of $32,300. They have a joint goal to donate $25,000 a year for the next 3 years to multiple charitable organizations. They plan to itemize on their tax return with deductions totaling $35,000 a year, which is $25,000 charitable and $10,000 in other itemized deductions. And they have highly appreciated stock shares, which they plan to donate. And you can see the cost basis and the value there. So again, a couple options. Option one, we can donate $25,000 of appreciated stock for the next 3 years. That is going to put our deductions, that's going to put us slightly over the standard and into itemized territory. And they would itemize $35,000 a year for 3 years, which is a total of $105,000. The cumulative taxes saved from those deductions over 3 years at 35% equate to $36,000 and some change. But really, there's minimal advantage here versus the standard deduction, which was already $32,300. So good for them. They are taking advantage of an itemized deduction versus a standard, but is there a way for this to be more impactful? And the answer to that is yes. So option two looks at utilizing a donor advised fund. So they're going to do all $75,000. That's $25,000 a year times 3 years. They're going to do it all in 2024. All right. Instead of doing $25,000 grants for 3 years, they're going to itemize on their 2024 tax return. And that's going to consist of $75,000 charitable deduction plus the other $10,000 that we saw in our initial facts. Then for 25 and 26, they're going to claim a standard deduction. So itemize the first year, standard deduction the next 2 years. That gives them an overall 3-year cumulative deduction of $149,600, and the taxes saved from deductions over 3 years at a 35% rate is $52,360. That is an additional savings of $15,610 by utilization of the donor advised fund. So no, they're doing the same thing, just their order of operations is a little bit different. And this chart is just breaking that down numerically. Again, so option one here on the left, our bunching strategy on the right, and you can see ID stands for itemized deduction, SD standard deduction, so you can see how those play out over the 3 years and then see their total 3-year cumulative tax deduction. So some considerations with this is, do you need charitable deductions to push you from the standard to the itemized? If that's the case, then this may be a viable strategy. You should consider donating your most highly appreciated shares, but you also need to consider what other portfolio rebalancing. So Rex and his team, if we donate stock, note that trading may need to occur inside of your portfolio to bring your asset allocation back into line with your risk tolerance. Partnering a donor advised fund contribution may be a really good idea to bring a Roth conversion strategy into play on the same year because of the deductions that are created by doing it. As we saw with the One Big Beautiful Bill, we now have some different puzzle pieces, namely the senior deduction to work around with that. You can donate other complex assets like private business interest, restricted stock, oil and gas royalties, and some other things. And then kind of more on the feel-good side of things, you can make grants in recognition of or memory of. And then the tax reporting on this, it's worth noting, is extremely efficient and streamlined. So it doesn't really create any headaches on that side of the coin. Last topic on my end, I want to talk about tax gain and loss harvesting. And so I think a lot of people kind of fall into really focusing on the loss side of harvesting, and I'll certainly will get to that. But I do want to mention harvesting gains as well. And so kind of one of the benefits of financial planning and tax planning being coordinated and integrated is that as a planner, we can map out cash flow with a very good amount of certainty, and we can be looking years ahead. And so, we can then combine that with tax rates and where the markets are. And sometimes it's a benefit to sell assets in maybe a lower income year and harvest gains at lower rates, understanding that it's going to be more penalizing to do the same action at a year down the road. And so mapping out cash flow planning years in advance allows us to potentially take, harvest gains for long-term tax efficiency. Harvesting losses is a bit of a different tax strategy, and certainly probably everyone's heard sell high and buy low, and you hear the term harvesting losses. Well, selling at a loss doesn't sound like a great winning formula, Craig. And if you were selling those positions and taking that cash and putting it into your pocket, I would agree with you. But what tax loss harvesting is the selling of non-qualified assets purposefully at a loss, but with the avoidance of wash sale rules, taking those proceeds and turning around and essentially reinvesting them in a very similar fund or investment. And what that does is that can create paper capital losses, and that can be of a tax benefit to offset other capital gains. Or you can claim up to $3,000 a year in losses against ordinary income, and any losses that you don't use up can carry forward to future tax years. Now, I acknowledge the fact that when we've had a run of good market years, that harvesting losses becomes a bit more challenging because typically this is a strategy that is created by market volatility. But know that it's something that our planners and our tax team and our investment team are actively working on jointly behind the scenes, especially as the year comes to an end, and we want to try to take advantage of this if we can. So here's a really simple case study to just kind of numerically illustrate this. So we have investment A, and we have a $30,000 realized capital loss. And with investment B, we have a $25,000 realized capital gain. So in terms of an order of operations, the first thing that we would do on a tax return, and Tim will probably touch on this here in a moment, but we're going to utilize the $25,000 loss and offset it with the $25,000 in gains. That leaves a $5,000 loss that's carried over. If we assume a 15% long-term capital gain rate, by doing this action, that's going to save us $3,750 in taxes. Well, then what can we do from there? We still have $5,000 of losses. Well, in addition to offsetting the gain, we can then utilize up to $3,000 of ordinary income reduction. And at 35%, again, think of maybe Bob and Sue, that's an additional $1,050. So collectively, we add that up by executing this action. There's a $4,800 tax savings, and Bob and Sue still have $2,000 to push to a future year again, to claim against ordinary income or offset other losses in a year where maybe we needed to fill their cash buckets or something to that effect. So that's it for me, guys. Now I'm going to kick it over to Tim Carter, and Tim oversees our tax division, and he's going to give you a behind-the-curtain look at some of our projection software and expound upon some of these case studies a little bit that we've already looked at. So, Tim, I apologize for cutting in here, but we cannot hear you. You may be on mute.
Well, there we go. I'm the technology advanced one around here. But anyways, again, tax planning, what we're going to go through is we have a program here called Holistiplan. And with this tool, we're able to look at the different scenario based on your individual tax situation, because let's face it, tax planning is financial planning. It's because every financial decision that you make, from how you invest it to how you withdraw it to how you spend it, all of it has tax implications on you. So we're going to go through a couple of scenarios here and take a look at them. Craig, if you can go to the next slide. In every scenario, it's different, but we're just going to take kind of some of the case studies that Craig had outlined here for you and kind of walk through so you can see what it looks like using this program. So in the first scenario we're going to look at, there's a married couple where only one of them is 65, and we're going to look at the tax law versus last year compared to what the One Big Beautiful Bill Act is going to have an impact on. So if you can go to the next slide, Craig. In this scenario, these clients have, interest, dividends, IRA distributions, pensions, Social Security, long-term capital gains. So if you go to the next slide, we have their total income at the $140,012. Under last year's, under the Tax Cuts and Job Act, their standard deduction would have been $31,600, but because of the bill, they got an additional standard deduction up to $33,100. They also get that enhanced senior deduction for their Social Security, so $6,000 more comes off their income. So if you go to the next slide, you've got the taxable income is reduced by that amount, which is down $8,000 and change of what you're looking at there. The total tax goes from $11,783 to $9,758, and they didn't do anything differently. They just had the bill passed, so that had an impact on their particular situation. So you can see kind of how it plays out in this scenario, and we can dive into your individual scenario and take a look at those differences. And we've been doing that as we're doing the Q3 and Q4 projections for you. All right, next slide. Now, you remember Bob who did the QCD? Well, I took a little different approach for him at that point, that I showed him that he didn't donate the money to the charity, but he just took the QCD, took the money as his RMD of the $42,683. So if you go to the next slide, his total adjusted gross income ended up being $122,000. Now, if he had made the donation from his RMD to the QCD, it would have brought his AGI back to $80,000. Standard deduction stays the same, but if you look at the bottom of the screen there, his enhanced senior deduction gets limited even more because of the RMD, because his AGI is over that $75,000 benchmark. So by doing the QCD, he also gets an extra deduction there by doing that, so that he's able to lower his taxable income even more. Next slide. So because of the QCD, now his taxable income is only $56,550, and his grand total tax bill is going to be $7,060. Not even keeping in course with the IRMA tiers at that point. If he hadn't donated it, it'd be even much higher. So the QCD, we can really drill down to see exactly what benefit he's going to get from doing that to help him make the financial decisions he needs to make. Next slide. All right, so here's Bob and Sue using the no donor advised fund versus the donor advised fund. And we went through and ran what the taxable income would be for each of the individual years based on where their itemized deductions would end up in 25, 26, and 27. So if you go to the next slide, if you look at those numbers for each of the 3 years without using the donor advised funds, they run about 175 to 171,000 in total taxable income. But that first year in 25, the taxable income drops down to 158. So that's where the biggest part of that tax saving is going to come from. But if you compare 26 and 27 on both years, they're relatively within the same market of each other. So the really big impact comes from that first year when we make the donation to the donor advised fund and how we can implement that. Next slide. All right, the tax loss harvesting. So we have the $25,000 in capital gains versus the $5,000 loss by us harvesting that $30,000 loss. So that's going to bring our income down dramatically. So if we continue to the next slide, if you look at the taxable income numbers there at the bottom of the screen, you're talking 219 compared to 188. Now, it doesn't take a genius to figure out my taxable income is going to look a whole lot better based on that. But what is the tax impact? Because those gains were taxed at long-term capital gains rate. So we go to the next slide. You can see there that the tax goes from 36,154 to 30,947 because of other deductions that are kind of taken into account there. So that's the big impact that this tool does for us, is that we're able to really drill down and see how it impacts your particular situation based on what we're recommending. So if you're not using our tax division at this point and want to take a look, reach out to us and we can drill down for you and take a look at how any particular situations that you have going on are going to impact you. And with that, Craig, I'll turn it back over to you.
Yeah, thank you, Tim. And again, just I think it's really neat to kind of take some of these case studies and show everyone in attendance the actual software that we're using behind the scenes to be able to run these projections. And again, to circle back to Rex's kind of initial comments, we understand today's webinar was a little bit out of the ordinary. Some of that was due to data available to us with the government shutdown, but also with a big piece of legislation, it seemed like a great time to be able to take advantage of that, as probably everyone's mind is shifting towards tax planning at the year end. And so with that, we will take some questions if there are any. Again, feel free to type those into the questions box in the chat. While we're giving that just a few moments to see if any populate, I will make a quick comment on one of the slides that Rex shared. I found the slide that showed the top 10 biggest companies from decade to decade to be highly fascinating, and kind of thinking about that in terms of how the tech companies and how the over concentration is at the top of the S&P, specifically with the Mag 7. And certainly a concept that we're thinking about quite a bit in our portfolios. So let's see here. We got one question. Are we seeing any overarching trends in the housing market? I think that obviously the housing market is going to, trend with, be subject to changes in rates with mortgages, things like that. I candidly don't have a great pulse on the housing market right now. And so I'd be happy to look into that further for you and circle back with a better answer. Tim, I don't know if you have any thoughts on that.
No, I think the housing market right now is just basically stagnant because everybody's waiting to see what the Fed does and the mortgage rates and everything else. So until that kind of gets rectified and we have some consistency that we know what the rates are going to be, the housing market's going to be kind of a demand based on I need to move, or I need to buy a house, or job changes, or things of that nature.
Yeah, I'll say what I can say in terms of the housing market, and not necessarily in relation to purchasing, but we definitely have seen trends in the rental market from the housing go up, and so demand seems to be picking up in the rental market, which would drive prices. So if you look at that conversely, I think that rates are in some capacity still very much restrictive to mortgages given income. So, but I'm happy to look into that a bit more further and circling back with the individual who proposed the question. All right, I think that is it. I don't see any other questions coming in, and so that puts us right at 5 o'clock. Want to be respectful of your guys' time. So thank you very much for joining us today, and have a great evening and be safe out there.